Hi, everyone. In this session, I'm going to be looking at often a taboo subject, and that is of losses, our trading losses. And from that, I want to hopefully show people that really, if we focus a lot more on handling these losses and the disciplines around those losses, then over the longer period, we're going to become much, much better traders. So I'm going to showcase the Aussie here, but the first thing we must do, and this is part of us being good traders, is we must understand and accept that losses are just a part of trading. We will always have losses. And there is an inevitability that alongside these losses, there will be some emotional responses from us. Behaviors may change, and we have to be careful of that. Now, the art of a good trader is to rationalize these responses. I appreciate easier said than done, but we need to be able to contain these emotions, and during the trade and indeed after any given trade, because it's how we respond after potential losses that will also help us in the longer run. So if we have a simple trade here, and we've all been in this camp, we've all put trades on, we've got the left-hand side there of the Aussie versus the US dollar, and we look to buy for whatever reason at 69.30. And, the market immediately goes against us. Never a nice position to be in. And what happens is that we get forced out. We sell our stop loss at 68.65. And as we see from all the expletives, we're not happy bunnies. We're very, very frustrated. Sometimes some people get angry about the whole situation. And in actual fact, whilst, these will happen reasonably regularly, the thing we have to really look at is, we got that trade on board for the reasons, what was our stop loss strategy? Did we sell at the levels that we thought we were going to sell at? Was it affordable to us? Did we actually have a plan at all? Because if we don't, and if we just enter into these trades on a random basis, thinking instinct is the thing that's going to pull us through, we're actually going to trip ourselves up pretty often, because timing can go out quite easily. And what happens is a succession of these, or even just one, can change our emotions, change our behaviors, and maybe we then go chasing the market. So the frustration here as well is that the market continues to go up after we've been stopped out. We then think the market is against us. Everybody's trying to make us lose money, when it's not the case. We've just handled this trade pretty poorly. We may have just been unlucky, but these are the type of things that happen to us all the time. So I'd like to, just go on to the next couple of slides and really show you, what a bad loss is and a good loss. Because in my opinion, a good loss can keep us going. A good loss will earn us the license to trade again. It's the bad losses that we need to get out of our portfolio, because they're the ones that destroy us. They're the ones that use up all our capital, and they stop us trading for a while, not just from a financial perspective, but confidence goes out the window as well. So in my opinion, a bad loss stems from taking decisions without having any trading plan. Now, some people may say that's instinctive trading. I actually believe even instinctive trading or traders have a plan in mind, because they do it on such a repetitive basis. So it's not a case of I'm taking away, the instinctive side of trading. It's people that just randomly go in. They either see a nice picture on a chart and decide, or, a social media channel says you've got to buy this asset class or anything of that ilk. You're going in a little bit blind. You haven't done your homework. And, that is going to cause you trouble. The other side of it is sometimes you do go in with a plan. You have done a bit of homework. Maybe you do know your levels, but you start deviating from those levels because your disciplines are poor, and because you start trading off the back of fear or panic. You you're frightened of taking a loss because you feel the market will bounce back in your favor. Unfortunately, we have to make these brave decisions, and these are the brave decisions that stop us getting into some of these bad losses. I mentioned instinct before. Again, some people are convinced that instinct is king, when in my opinion, being prepared is the biggest key to success and sticking to that plan. So what happens here on this example is that we quite simply sell a dip. We're selling without any protection at all because we're not planning. So basically, we've gone in at a level, we know nothing about other levels around the market. The market, in this instance, it goes in our favor, and we're happy with that. But again, because we haven't got plans, because we don't know what true levels are in the marketplace, we are just happy with that profit. And we don't take any profit. One may say that we get greedy. Others would say it's because we actually don't know where we're going to take profit. And then the market bounces in our face. And we just simply don't know how to handle this bounce because we've not thought about this trade at all. And there may even be some opportunities where we could get that trade back flat, but we don't take advantage of those opportunities, even though things may have changed, because we haven't planned for any of these moves, for or against us. And then what happens is we get a piece, in this instance, of CPI data. Now, we're probably not even thinking about that CPI data. We've allowed this trade to run over it. And actually, in the end, volatility comes into the marketplace and bang, the market goes well in our face. We get so frustrated and we're actually saying to ourselves, I can't cut it up here. It's too expensive. The market then dips in our favor. We think all's good again, and then off we go again. We're not reading any tea leaves. We're not reading this data release or anything like that. And as we all say, the market's against us. Invariably, we cut at the top. We get very angry. Our behaviors change. Now, we will have the odd one of these in our portfolio because we're human beings. But what we have to do is try and stay in control of the situation at all times. And so we must learn from any of these bad losses, in my opinion, and take the good parts of it into creating small losses when the situations go against us. Now, how can we do that? Well, quite simply, it's all about preparation. Quite simply, it's about trading your plan. So when we have a trade idea, we go through that process that we speak about, and we can then basically continue trading because we've done our homework. We know why we're going into that trade. We know where the good levels are. We know when the data releases are. We are at our most informed when we go into that trade. So we can respond to moves up and down, for and against us. And as the market does move, we can actually handle any situation. We know where our take profit levels are. We certainly go in with a decent, affordable level of protection. And the key thing is, unless anything significant changes to our trade idea or to data coming into the marketplace, new price action, we need to stick to that plan, because we know if it goes wrong and our trade idea is wrong, we're going to get stopped out at an affordable level. We are creating a good loss. Now, some people will say that's an oxymoron. It's not. A good loss is what helps you fleece out the bad trades. It doesn't hurt your P&L too much. It doesn't knock your confidence too much. So you've followed an anticipated range of moves in the marketplace. You've got your orders in place and you're constantly monitoring the fundamentals. So we are not going into this trade blind. We're not saying instinct is key. We're actually well prepared for this. And one of the key things on these trades is that with that decent stop loss in there that's affordable, we take away quite a lot of the anxiety, because we actually know if this goes wrong, how much it's going to cost us. Of course, we don't want it to go wrong, but we're prepared for it because we know sometimes they are an eventuality in life. And the key thing here, as we would go through this trade, is that we would also know when this CPI release is coming out. We would also know our levels, and if we broke some of these key levels, the move would accelerate. So we potentially could flatten this trade prior to the number. Again, that will be sensible trading. Or if we wanted to run it over that number, we would know as we look at the data that comes out, if it is not in keeping with our view, then we should and will cut that out very, very quickly as part of that accelerating move. So we don't get involved in all the noise afterwards. We reduce our losses. We're getting ourselves out at the right level, and then we're cheapening it up as much as possible. That is a good loss. So all I'm talking about here is discipline and planning. And that is what sits behind all the best traders. So very quickly, if I can summarize there, what we want to do when we recover from these losses, because we know they're going to happen, by actually embracing them, it's a positive step forward. We can stay positive. We accept anomalies will frustrate us and will take out a bit of our bottom line, but we learn from these as well, and helps us continually evolve our own style. We're respecting the market, but we're not afraid of it. So when it gets to certain levels, we're respecting it. We're doing what we need to do, rather than when it gets to levels that we don't know nothing about, we actually start fearing the market. And that's where all those traits come in that we want to avoid. And we have the money to trade the next day. Now, the key thing is learning from these trades, these bad trades that go wrong. So reinforce, evaluate those trades or individual trades, or at the end of any trading session or end of the week, use your diary, analyze these trades, try and feed, the good stuff back into your process, and make sure you don't repeat some of the poor moves that inevitably we will make. This is a short evaluation, not a post-mortem, because sometimes when you talk about losses, it turns into a bit of a post-mortem and you beat yourself up too much. You have to stay positive off the back of some of these losses. The other side of it is, if all of a sudden there's too many losses on the spin, you need to decompress, get away from that trading screen, whether you take time out, whether sport is your thing, or you go out with your partner, or you spend time with children, whatever is your thing that helps you decompress. And I'm not even talking about going away for a week. It could be, as an individual, you can respond to being away from your desk for an hour. You take stock of what's gone on, and then you come back. If you are in this situation where you're taking losses, what I would advise is ease your way back into trading. Don't try and get all of your loss back in one go. And most people do that by increasing the amount of capital they put into each trade. I would err the other way. Ease yourself back in, reduce the amount of capital that you put in, get your confidence back, and very soon you'll be making good money. Hopefully that helps, and I will see you again in a couple of weeks.